For Morningstar, I'm Jeremy Glazer. The Berkshire Hathaway annual meeting is this weekend, and I'm here with Gregg Warren. He's a senior analyst at Morningstar. He covers Berkshire, and will be on a panel asking questions of Warren Buffett and Charlie Munger. Gregg, thanks for joining me.
Thanks for having me.
I want to talk about some of what you think are going to be the big topics at the meeting. There aren't really any maybe burning issues. There have been in some previous years, but one that always comes up is succession planning. But there's been some movement there. Do you think that question has really finally been put to rest?
I think the easy answer to that is probably no. I mean, we still don't have complete clarity yet on what's going to happen with succession planning. And I think, for Berkshire overall, for the shareholders, here you've had two guys running the show for 50 plus years now, and to have this lack of clarity this close to what would be expected to be sort of retirement is an uncertainty, I think, for everybody. That said, we did get some sort of hint of where things may be going. We had Ajit Jain and Greg Abel named to the board of directors earlier this year. Ajit, has run Berkshire Hathaway reinsurance for many, many years. And in his new role, he'll basically be overseeing all the insurance business, which I think is something he's always wanted to do. With Greg Abel, who's run Berkshire Energy for many, many years, and has done a lot of deal making during that time, a lot of M&A activity. We still view him as being the next CEO, the next capital allocator in chief, which is something that Buffett sort of put out there. And he'll be overseeing in his new role all of the businesses that are non-insurance. And I think from that perspective, we still feel like he's the next guy to run the show. You've also got Todd Combs, Ted Weschler there from an investment perspective to help back him up there. And I think Ajit's not necessarily going to fall out of the picture. I think he'll still be helping them out with risk assessment and other stuff.
Do you think that they'll address Wells Fargo and the scandals involving Wells Fargo directly? They're obviously a major shareholder there.
Yeah, the interesting thing with Warren is he tries not to talk up or talk down stock holdings, especially in situations where they're major stakeholders. I'm sure there will come be questions put to him during the course of the meeting, and I'm sure he'll answer things in his way. He likes to deflect a lot and not necessarily get to the point of the answering the actual question itself. But I think overall it bears looking at and it bears talking about. The question is how do you formulate the question in a way that he'll actually speak to it. Just from some hindsight, there was that one year where I asked a question about American Express. They were going through a lot of different issues competitively, so it was more directed toward looking at the moatiness of the firm, the competitive positioning, and trying to sort of get at that. And he spent the next 5 minutes talking about the history of American Express. So it's a risky proposition asking a question along those lines, but he has surprised us from time to time. So I would expect to see questions coming that way.
Let's talk about the cash hoard. Is there any way that they can actually deploy the amount of cash they have on their balance sheet right now?
Yeah, it's really tough. I mean, they were at $116 billion at the end of last year. You're looking at a firm that's on pace to generate $20 to $25 billion in free cash flow, and that's even before you roll in the tax cuts. So, they're going to be at about $150 billion dollar mark in 2 years, and that was a threshold that Buffett had put out there last year as far as. If Berkshire's sitting with $150 billion a couple years from now, and I've not deployed it any place, it's going to be hard for him to explain that to shareholders. And if you look at sort of where market valuations are right now, there really isn't anything cheap out there to buy, and it'll run contrary to sort of his wanting to get the best possible deal when he makes an acquisition, and the stock's trading well above the share repurchase threshold. So unless he's willing to change his spots on how he thinks about valuation of companies he's buying, or how he thinks about valuation for the shares that they're buying back themselves, they're going to be sitting on a lot of cash a few years out. And our expectation has always been, they're likely to put a special dividend out there. Our current forecast has a $25 billion special dividend paid out in 2020.
Let's talk about insurance losses. 2017, there are a number of big hurricanes, some catastrophic losses there. Any questions around the insurance business, how they handled those losses, or was everything about as you would have expected?
No, it was actually a little bit. It was 6.5 I mean, there were some of the reinsurance we had thought they'd be a little bit lighter than it was, because they've actually sat on their hands a lot the past 5 to 10 years on reinsurance underwriting, just because the pricing environment's been really poor. But to walk away with less than $3 billion in losses overall for 3 major hurricanes, a few earthquakes, and a couple of other catastrophes, I think was doing pretty well. From the perspective of the business overall, our expectation on reinsurance is pricing is still going to be rough, and you're always going to have a catastrophe year somewhere in the cycle. We always build in one at least halfway through the cycle to make sure that we're looking at the business from a prudent basis. We're expecting a loss year going out. But I mean, overall, I think they handled that well. And when we look at the business as well, I mean, Geico has been a lot more aggressive the past couple of years on underwriting because their peers have stepped back from underwriting in some parts of the market, and B, I think they're eyeing that market share that State Farm's sitting at right now. Geico's sitting around 13% market share. State Farm's traditionally been around 18, 19. They're the market leader, so I think there's a bit of a push to really take additional share when they can, which means you're taking on some losses because you've got to season those portfolios over time. So the expectation, at least ours is over the next several years, is they're going to accept larger loss ratios on their auto insurance portfolio as they take share. And I think that, given the fact that Geico is one insurance business within a larger portfolio of insurance businesses, within a larger portfolio of overall businesses, they can afford to do this. I mean, this is something that Progressive, which is Geico's prime competitor, on the direct side, couldn't do. They couldn't take the kind of losses that Geico's taking, just because, they don't have that same sort of backstop.
Gregg, thanks for the preview of the meeting.
Thank you.
For Morningstar, I'm Jeremy Glazer. Thanks for watching.